remembering when we're thinking about our adjusting entries, it's useful to think of it as a separate process, even if we're the one doing both processes, which oftentimes we might not be, because it might be done not by the accounting department so much as the public accounting firm or the tax preparer or the CPA firm at the end of the year. The objective of the adjusting entries being to make the financial statements correct as of the cutoff date for whatever accounting basis we're using, which might be an accrual basis and or a tax basis. I would usually take the accounting information, even if it's in a software like a QuickBooks and a Xero, and I had access to the software, I would still export that information, make a worksheet, possibly not like this, more like with debits and credits typically, but we're doing it with an accounting equation here so that I can see the adjusting entries in a more transparent format. This format works great for transparency when there's not that many transactions. That's the point. The reason you need an accounting software oftentimes and an entire general ledger report is because there's so many transactions that in a worksheet like this, it would be overwhelming. It'd be too much. But if we're just doing a few adjustments, then this is perfect. It's nice and transparent and we can see everything that's going on. That's going to be the point. Once we're done with that, we could then think about putting it back into the accounting system to make sure that our adjusting entries line up to what's in the accounting system. However, there could be problems in doing that because the bookkeeper has different objectives. It's not like our adjusting entries we're fixing errors so much, although that might happen. We might be fixing some errors, but our real goal is to say the accounting department is doing something different and we're shoring it up at the end of the process, meaning the accounting department's objective is to work with the people they're working with, customers, vendors, employees, as smoothly as possible and try to automate the system as much as possible. And if that means that the timing differences that are going to be used or some categorizations, such as short-term and long-term loans, for example, or the grouping of accounts together versus breaking them out, is easier for the bookkeeping process, or even naming the accounts with like loan numbers in it or something like that, or bank account numbers. If that's easier for the bookkeeper and the accounting department, then we want them to do that. And then our goal on the adjusting process is to shore that up by making the financial statements correct according to whatever basis and then cleaning up the reporting to whatever format it needs to be, whether it be tax return or external reporting. So now we want to put our information, the adjusting entries, back into the accounting system and not mess up the accounting department or bookkeeper. So one way to do that is with the application of reversing entries. Right? Because if I made a change for a timing difference, then they're not wrong. Their timing isn't wrong. It's just not perfectly accrual the way we need it to be for external reporting purposes. So I'm going to reverse it, going back to their system so they can enter their information, achieving the objectives that they have during that time frame. So that's going to be the idea.